So I'm going to welcome Tim up here in a minute, but this really is a tax strategy for business owners and professionals. I'm one that believes that it's our duty to pay less in taxes because the government is not always the best allocator of resources. If anybody agrees with that, you could put something in the chat there that you agree with that. But what we're going to do here is this is going to be purely educational. We're going to have a really great time talking through, what some of the changes are. There's some legislation going on right now that's changing some of the laws on depreciation. We're going to look at that. We're going to talk about some of these things, and there's going to be a chance to ask questions and just really figure out, what are some questions that you have by being a professional or business owner. If we have not met before, my name is Bronson Hill. I'm the CEO of Bronson Equity. We have about 200 million in multifamily assets. We also do things that cash flow, like ATM machines, car washes, oil and gas, some other VC deals, and we really try to provide investment opportunities for investors. We also do events like this. We're really passionate about education. So I'm the author of this book behind me here called Fire Yourself: Replace Your Working Income with Passive Income in 3 years or less. I have a whole chapter dedicated to tax strategy. But actually, Tim and his group actually helped make some contributions too. So I'm very grateful for that, Tim. But I wanted to welcome you, Tim. This is Tim Gertz, who is a well-known CPA who is at Provision Wealth, and just a great guy, stellar reputation in the industry, does a lot of consulting. And really, there's a difference between someone who is just and I say just, which, the tax code is thousands of pages. That's a lot of work as well. There are people that file taxes, and then there are tax strategists, and his group really does both. And where Tim, I think, really shines is in that tax strategy piece. And I believe we have, I'm sorry, it looked like somebody in the chat said we had a different start time. So I'm sorry if we had a different start time there. Barrett, thanks for your flexibility. So Tim, why don't you give us a little background, kind of how long you've been doing this, and just say hi to everybody, and you say a few words here.
Yeah, definitely. So happy to be here. I'm a CPA. I've been in public practice for probably about a quarter of a century now. So getting up in age. But always worked in niche markets, boutique firms that dealt with entrepreneurs. So I've always worked with high net worth individuals, entrepreneurs, people that are really looking to control their own destiny. And throughout my career, I've gone through different market segments, working with high net worth individuals that are C-suite, C-suite employees, large equity accounts, and then all the way to small business owners that are sole employees with an S corporation doing plumbing. A large tranche of what I do is in real estate. About Provision as a whole, about 95% of our client base is real estate related, meaning that they have some sort of investment in real estate, whether they own an Airbnb or have a rental that's wholly owned, or they are developing a $100 million commercial complex.
Yeah, it's awesome. Yeah, I know you do a lot of different things for a lot of different people, and you're, really asked to help for a lot of different strategy. Actually, I can't say who it is, but there's someone that I saw on this call who was able to use your services, and again, without being too specific, found that if this person were to leave their job, they could keep more money by being a real estate professional and staying at home rather than going to work, which is really amazing, right? I know we're going to talk about the real estate professional designation, which a lot of people have a lot of interest in. So we'll kind of jump in here in a minute. We'll take some questions. If you do have questions, you can drop them in the chat. Kind of the outline for this is we're going to kind of jam on some stuff for a little bit. We will take some questions from the audience. We'll kind of dedicate the end to that. If you do have anything you do want to hear, make sure you put that in the chat. Everybody's interested, especially this time of year, about creating a strategy for taxes. But let's talk a little bit. I think the hot topic that people are talking about, a lot of folks have learned that we used to have 100% depreciation potentially for different investments, whether it was equipment, like we do the ATM machine fund, we're doing multifamily deals, other things. And now it was 80% last year. This year it's 60% year one, and then you can use that for future years. We've seen, it's been passed in the House. The Senate has not, I guess it's kind of stalled there. Can you talk a little bit about what you know about that and what implications that has if it gets passed, and just touch base on that?
Yeah, definitely. So it's an extenders bill. It was introduced in 22. It was introduced in 23. Now it was introduced in 24. It's made its farthest leaps in 2024 being passed by the House. But really what it focuses on is what are called extenders. It's extending the tax law on provisions that came out of 2017 that were what are called sunset provisions. So in order to pay for a tax act and to have the ability to balance that act, they have to have provisions that sunset provisions. Bonus depreciation came out in 2001. It's always been a sunset provision. It continues to be kind of re-upped every now and again, whether it's every couple of years, every 5 years. This is the case with this current iteration. It started at 100% in 2018, 2017, and it has gone at 100%. And then in 2023, it started to phase out. And so it's scheduled to be gone by 2026. This bill would extend that. It would bring it back up to 100%, which would be a huge boon for any capital intensive industry, whether it's manufacturing, whether it's real estate, whether it's, your business that you have a lot of personal property in.
Yeah.
In addition to that, another one, the two other things in the extender is the excess business interest limitations, which no one really cares about, and then the R&D credit. That was the one that actually took the biggest hit and is taking the biggest hit. And so that's kind of the driving force behind this. About 50% of the revenue from this bill would come from the R&D if they brought the R&D credit back to where it was prior to 2022.
So the R&D credit, that's a credit that it goes to investors, or they're able to get a credit back. So that's, we have one deal that's kind of a VC tech deal, and that in the oil and gas space, and that was an issue. They said this would be really significant in that area. And then obviously we just have to wait and see. So you were saying, hey, if you want this to pass, just call your senators and let them know, right? That's kind of
Yep.
how we can.
Yeah, it's in Senate right now. They come back into session in the coming weeks. They're kind of holding the fate right now. So if you like what you saw in 2017 to 2023, I'd reach out to your senators and say, hey, we need to get this passed.
Got it. That's great. Okay, so I did make a note here. There was an error in the information that came out. We start these at 4 p.m. Pacific, and there was some communication that came out that said it was starting at 3:45. So Tim and I met at 3:45 Pacific, and so I do apologize for those that are waiting. I sincerely apologize. We have some new team members, so we're getting things corrected. So thanks for your patience on that. And again, this will be available in a replay as well. Let's talk a little bit about, if somebody I think one of the challenges, I worked with a lot of physicians for years. There's a lot of people that are high earners. A lot of people have a W-2 or a 1099 or have, I think it's the hardest tax to kind of reduce, right? Is when you're a high paid employee, and it's really challenging. Can you talk about some strategies for high paid professionals? If I make, 200, 500,000, $1 million a year, what are some things that, and again, we're just talking generally, what are some things people do to try to reduce the taxable income that they would pay?
So yeah, I mean, W-2 employees are the highest taxed. That was by design. It's always been by design. It was hit home a little harder in 2017 when they got rid of some of the other deductions, like tax deductions, unreimbursed employee expenses, things of that nature. So yes, as an employee right now, you are basically what is generating the revenue that drives the country. And so it is the most difficult position to be in, to be able to reduce that tax, because that's not the incentive that they have. The incentive they have is to drive industry, to create jobs, to tax the employees. So when you're looking at that, the things that you want to look at is, what are you currently doing? What can you do? What type of investments do you do? What investments make sense to you? What investments hit your criteria? Are there investments out there that are advantageous for a W-2 employee? One of those would be oil and gas. Oil and gas has a carve out of passive activity loss rules that says if it is a working interest in oil and gas, that income is created and considered to be active. That loss is considered to be active and can be utilized to offset W-2 income, even if you aren't active in that business. So that's a huge carve out. It's been around for years and years and years. Again, you've got to look at, is the investment a good investment? Don't do anything for tax benefits. Always make sure it's a good investment, but oil and gas would be one that you could utilize to offset. Another thing that a lot of employees do is, are they married? Do they have a significant other? Is that significant other in a position, you had said earlier, Bronson, in a position where maybe they're earning X, and if they were to go into real estate and utilize the real estate professional designation, that X would be monumentally less than the tax savings that they would get by being a real estate professional. So that's another area that people look into is, in the current tax law, a W-2 employee can be offset. You can offset up to $586,000 of a W-2 with losses from real estate, but you have to be a real estate professional. So is that something that you can attain? Another idea is looking at charitable deductions, looking at trusts, looking at gifting strategies. These are all things that you can do as an employee.
Right. So I know you are a tax strategist. You have, a team of CPAs and folks working with you. And I know you will meet with people. So some people on this call may want to set up a kind of an introductory call, and you guys do kind of a free consult to see if it makes sense. But who is the ideal individual that gets a tax strategist involved? What are some scenarios that's like, I make this amount, or I pay this much in taxes, or my spouse and I do this? Like, who's kind of the ideal person that you work with?
Typically it's entrepreneurs, number one. So you are not the high paid W-2 earner that has a 401k and a financial advisor at Fidelity, and 100% of your income is going to that financial analyst. That is not someone that we can really utilize the tax code to strategize around. But that individual that has a wife that is entrepreneur in nature and wants to invest in alternative investments and are looking at real estate would be someone. So typically, number one for us, entrepreneur. Number two is we look at accredited investors. And the reason for that is typically, to be efficient in tax law, you really want to look at getting out of that 37% tax rate, that 35% tax rate, that 32% tax rate, and getting down into the teens, the 10%, the 12%, using the credits. So if you have that opportunity and you're already up there, we have a lot more room to work with. If you're making $100,000 a year as a W-2 employee, or if you're making $100,000 a year as a real estate agent, there might not be enough for us to do to add the value that we need to basically be the return on investment that we want.
Right. Right. And that's the thing that there's a fee to do it, but it's to make sense that, you're going to find a strategy that works for the people involved. So let's talk a little more about that for business owners. Going to a lot of people own a business, or maybe someone is thinking about starting a business. What are some of the advantages of owning a business, and what are some of the common deductions? Or I know it depends on the business for sure, but what are some things that you've seen people do that have been very effective that like maybe a lot of people don't know about?
I mean, ultimately, as a business owner, you've now got this opportunity, and that opportunity is to have business expenses. And business expenses are deductible if they're ordinary and necessary in the course of business. So now, as a business owner, it changes from this expense is not deductible because I don't own a business to this expense can be deductible if it's ordinary and necessary in my business. So the first thing that I always tell people is to look around at what they currently are doing and look at every expense they have and see, is there a way that we can change our facts to make it ordinary and necessary in what we're doing? That's home office, that's vehicle use, that's travel, that's meals, that's, do I have a business and I am renting an office? Maybe I need to buy a building. Do I have that opportunity? Now I've got depreciation in the mix because now I've got that piece of real estate that I'm using as an investment. It's a return on investment because my business is paying for that asset and I'm getting the tax deductions from depreciation. Things like that. Just really kind of sitting down and looking at what is your business doing, and what are you currently taking as deductions, and what could you be taking as deductions? Because again, everything that you're doing with tax law is incentivizing you to grow your business. So that's why they want you to take those deductions. That's why they want to give you credits. That's why they want to give you depreciation, because they want to grow that business. Because now if you're Joe, who is the only employee, and you double your revenue, well, maybe you need another employee. And that employee has no deduction. So guess what? That employee is paying Social Security, Medicare, and income taxes.
Yeah, absolutely. Yeah, it's amazing. People wonder, I talk to some people, live in the great state of California and in LA. We get a lot of people that are, have, different, there's all different political views, which is fine, but it's, some people think it's wrong to not pay taxes or to, and there's a difference between, tax evasion, which is illegal, versus tax avoidance, which is kind of like our responsibility. Hey, if you're doing activities that the government deems to be valuable, such as providing housing or providing jobs, they find a way to incentivize it because they're not as good at that as the private sector. So, and do you find that's pretty much true? I don't know if you do international consulting as well, but do you find that's true of most countries of the world where there's some similar type of tax incentives around the world like this?
There is. I mean, it depends on the country. We don't do a lot of internet after the whole GILTI tax law came into play. We kind of walked away from international taxation simply because there are so many nuances, and we're dealing with a large tax code federally, and then we also have clients in every state. So we've got to understand every single state statutes as well.
Right.
But yeah, I mean, everything is an incentive. If you think about it, everything that they are doing, oh, we're going to give you credits to put solar on your roof. They want to incentivize you to do that. We want you to buy electric vehicles, so we're going to give you credit for that. We want, whatever it is, we want you to build houses. We want you to bring on employees, so we're going to give you a deduction for that. We want you to do research. We want you to do development because we want to bring that industry into the United States so it can grow our GDP. We're going to give you a credit and a deduction for it. So, I mean, everything that you can do to incentivize to build this nation is being driven by the tax deductions in the tax law.
Yeah, absolutely. That's yeah, that is something a lot of people don't understand about taxes for sure. What are some do you have any other tips? I mean, I found we were just even on the call before I was asking you a couple of questions that related to, if I sell gold as a real estate professional or what, all these different things. And I know a lot of times people is there, I mean, is it, I know that these laws change, so it's important to have a CPA or have someone that you can go to kind of get feedback on. Um, is it, I mean, how does that generally work? I mean, if you have a client that's working with you, I guess there's a couple different types of clients. One would be someone who's, you're doing their taxes, and another one is more, you're doing more of a strategy and more of a plan for them. Do you typically, and again, I'm more curious on how this is done across the industry, maybe for you or for others, but for CPAs, is it typically like, hey, I have a question and I need to talk for 10 minutes? Is that usually billable, or does it kind of depend on the relationship with the CPA, or how does that typically work in,
It depends on depends on the CPA. It depends on what the relationship is. We are proactive in our strategy, so everything we're doing is forward thinking. So we're talking to our clients, whether it's we're talking to our clients when they first come on and doing a strategy, sitting down and looking at where have you been, where are you now, and where are you headed, and making sure that we've captured everything that you're trying to accomplish and having a good framework to move forward. And then from that point forward, doing proactive planning, whether it's quarterly, semi-annually, annually, dependent on need. Once we get past December 31st, what you can do is very limited. And looking backwards, you've got, I can contribute to a SEP, I can contribute to a IRA, I can potentially do some state tax credits, but really after December 31st, there's really nothing you can do that will save you a dramatic amount of taxes or allow you to be efficient in what you're doing. And so you were asking earlier, kind of what can you do as a business owner? What we do when we work with a business owner, or we work with anyone, because everyone is a business owner in our ecosystem, we're looking even at the year end when we're doing planning, where are we today and where are we going to be next year? And we look at what deductions can we take today to drive down our tax bill, but not negatively affect what we're doing tomorrow. So a perfect example, I just talked to a client today. 2023 was it was a very odd year. People sat on the sideline. People didn't invest money. People were holding money. People didn't know if, the housing market was going to crash, interest rates were going to go to 20%. What was it going to be? And so there was a lot of people sitting on the sideline. And this individual sat on the sideline and did not invest. He basically squirreled away cash and had a powder keg of cash. Well, it resulted in him essentially having a 22% effective tax rate. We talked about it today and we said, hey, this is what your effective tax rate is for 2023. But what that allowed us to do, especially if bonus depreciation comes back into play, is all that money he didn't use in 2023 that would have been deducted at 20%, or sorry, at 80%, now can be used in 2024 to potentially be deducted at 100%. And on top of that, his effective tax rate was 22%. He makes over $1 million a year. So we know the first $450,000 that he's going to pay tax on is going to be taxed at 37%. So just by sitting on the sideline, he's effectively made a return of investment of 15%. And so that's kind of what we look at doing with our client base, is not only what can we do today, but what are we doing that's not going to harm you tomorrow? And that's a very valuable conversation you should be having with your CPA.
Yeah, yeah, that makes sense. And I think let me ask you a question here, because I know I think CPAs, or people to do your taxes, not only CPAs, there's the tax preparers as well. There's a lot out there. There's not a lot of tax strategists. How did you get started in tax strategy? And another kind of side question is, how should people I guess, how would they vet a tax strategist? Because I know there's a lot of people saying I'm a tax strategist, but when someone says that, like, I know you guys know what you're talking about, but how do you kind of vet that out?
So how I got into it is I love strategy. I love building things. I love developing opportunity. And so for me, it was just a function of, I am probably not the only CPA, but I'm one of the most vocal CPAs. I hate tax returns. I can't stand tax returns. I hate bookkeeping. If you wanted to put me in my own personal hell, you would have me sitting in a corner doing bookkeeping for the rest of my life. I can't stand that, because it's X's and O's.
Mhm.
It's rigid. There's no creativity in it. And so tax strategy for me is fun, because I actually not only get to help families generate wealth through tax efficiencies, but I also get to know my client base. I get to know what they're trying to do. I get to know that Joe in 5 years wants to retire and buy a cabin on the lake. And I can help him get to that by the strategy that we're doing. So for me, it's much more valuable. And I feel I add much more value in doing that. When it comes to vetting, I mean, honestly, to vet a strategist, to me, is to have the strategist be the one driving the ship. So
Right.
if you're talking to your CPA when you're preparing tax returns, or your tax preparers when you're preparing tax returns, and you don't hear from them until January 1st of the next year, when they're like, hey, give me your information so I can prepare your tax return, they're not the ones for you. If you sit down and you have a conversation with your tax preparer, or you're doing an intra call with your tax preparer, and the hour-long call is 100% them just peppering you with questions, they're the ones for you.
Because
And
they're trying to figure out what ways to maximize your strategy and who you are. And I think it sounds interesting when we have intro calls with investors. It's like there's a lot of information gathering, just figure out who this person is and what they need. And it's a lot of times we say, well, we're not really a good fit because you're looking for something different than what we do, right? It's just finding the right type of person that, and I'm sure you'll probably have calls and you'll spend 30 minutes with somebody and be like, I don't think we can help you because we do this type of thing and this is who you are. So it's, it's a selective practice. I know I was looking through the list of who's in here, and I know there's some people that own a business and would consider selling or have thought about selling a business. We're going to start taking some questions here in a minute. So I see one question. We'll get to Barrett, your question here in a minute. And if you have other questions, just drop them in the chat. We'll get that started. But what are some things to consider if I have a smaller mid-sized business? What are some things that can be done to kind of plan for the tax strategy, whether it's a multi-year kind of installment sale or some other strategies people use going into that?
Yeah, I think it depends on where you are, what your intent was. Most of the times when you're starting out, I'll ask, what's your intent? Is your intent to build and grow this business and live off of this business, or is your intent to build, grow, and sell? And so those are things that you have to look at, because they go in different paths. There's short-term pain for long-term gain in the path of build, grow, and sell. And there's long-term gain and short-term gain and long-term pain on the flow-through avenue. So it really depends. But I mean, structuring is huge. Structuring is huge. What you can do with that, how you can structure it. There are opportunities to potentially roll over equity. If you're looking to sell, maybe you're selling to a PE and you have the opportunity to defer equity by a rollover. Again, looking at, what am I doing? Real estate professional is an annual election. What am I doing with my business? And what do I have? One of the strategies that you could potentially utilize is, hey, there's two options. I mean, I've got a client that sold his business for a very, very, very large chunk of change, and he went straight into being a real estate investor. We structured it around selling at the first of the year. So I told him, here's your options. We sell December 31st. This is what you're going to owe in tax, because there's nothing we can do. You sell January 1st, we've got 12 months to plan for this. Right. And so running up to that sale, he started to build the structures. He brought team members on. He built himself a family office. He got everything involved. He got his wife involved. He did everything. And so the next year, he invested as much as he possibly could into real estate as a real estate professional, and was able to offset. It was north of $100 million worth of income. Wow. By doing that, simply because he took the steps that he needed. Again, the tax code incentivizes you to do that. So are you looking at doing that? Or maybe, hey, I've got all this investment that I've been doing. I've got this business. I've been using the income from that business to invest in real estate. I've got a 30 unit, portfolio of single family houses, and I've always had them managed. Well, maybe in the year of sale, you pull that back, because real estate professional is an annual designation. You can be a real estate professional in year 1 and not in year 2, and then again in year 3.
Wow. Yeah.
Maybe you pull that back and you become more intimately involved in the management of your real estate, so you can become a real estate professional. And then maybe we do a cost segregation study and pull all that depreciation to that year and potentially offset some of that gain.
That's really magical with the real estate professional designation. I think it's something that, if people are interested, or, we'll see it with someone, person is a professional, like a doctor, and others are a high earning CEO. And then the other person's like, hey, I can do this 15 or 20 hours a week, and I get enough hours and I have enough depreciation. Of course, there's certain rules to that. If we get some questions on that, we can talk about that. We are getting a few questions here that we'll kind of start answering some of these questions. And then, so if you do questions, stick them in the box. Let's talk. This is actually, Barrett's got a couple questions here. So we'll start with the first one. Let's talk about, he's asking, you don't do international. What about if, and I don't know what this is, if clients are in a group captive insurance program in the Caymans, do they utilize your firm? Maybe you could talk about what that is, a captive insurance program. I'm not even familiar with that.
So captive insurance is reinsurance. We have lots of clients that do captive insurance. It's an opportunity for individuals that have closely held businesses, high revenue, closely held businesses, and have inherent risk in those businesses. We do work with clients like that, but we do not prepare any captive insurance tax returns. We believe in focusing on what we do and what we do best. So we focus on 1040s, individual returns, partnerships, S corps, C corps. We don't really do any of those specialized forms, captive insurance, things of that nature. defined benefit plans, such.
Right. Okay. A couple questions are coming here from a tax strategy service. One is asking about kind of ballpark costs. And then also, do people just kind of meet with you or, as a tax strategist once or one or two times, or is it kind of an ongoing thing that people do kind of as an annual thing? I'm sure there's different types of packages. Maybe we talk about how things are structured generally from a tax strategy. And then if you can share anything about kind of general costs.
So typically, tax strategy is going to be over a period of time. And it really depends on where you are. If you're just starting out and you've got a couple pieces of real estate, or you've got a closely held business that's just starting out, maybe that need is we meet a couple times over a 3-month period. Or if you come to me and you've got a 50 unit, portfolio with multifamily, and we've got a ton of structuring things to do, you want to do estate planning, we got to bring in an estate planning attorney, that could be over a 12-month period. And that might be once every month, simply because that cadence allows us to bring in those other team members, bring in the estate planning attorney, and utilize what they're doing inside the strategy that we're putting together. So it really depends. I hate the response of it depends, but it is a function of how complex you are. So,
Right.
and then once that's done, then it becomes a situation of need. I always tell my clients, we can meet every week if you want to, but you don't want to pay me every week if you don't need to. So I look at what's the need. I've got clients that I meet with every 2 weeks. I have clients I meet with monthly. I have clients I meet with every 2 weeks or 2 months. I have clients I meet with every 6 months or once a year based on their need. If
Right.
this is just a function of we've got this finely tuned machine and we're just maintaining it and we're not really growing it, then maybe once a year works. If you're moving and shaking and you're creating new entities and new ventures and you're raising capital for multifamily, then maybe we're meeting, every week. It just really depends.
Yeah. Yeah, it makes sense that there's, they're putting a plan together, which, there's a cost, obviously thousands of dollars to do this is not like getting a meal or something. It's a plan, but again, there's a saying by Warren Buffett, price is what you pay and value is what you get. So if you're going to save tens of thousands of dollars on your taxes, you can quantify that it's worth paying money. And that's where I find a lot of people, actually, I meet with a lot of or 2,000 one-on-one phone calls with high net worth investors. And I'm surprised when I meet the number of people that actually do their own taxes. Because it's like, first of all, your time is valuable, but secondly, like there's these laws change all the time. And I remember my experience years ago in college trying to do my own taxes. And then my tax preparer was like, "Oh my gosh, I found all this more money for you." And I just was kind of shocked that it was just something I didn't realize. So I think it's always worth getting a second look, and it's always worth having. And then the thing too is when you have someone doing taxes or working on strategy for you, like it's your name on the line and it's like you have a license here. So if something goes wrong, you say, well, I was trusting my professional that does this all the time. And of course, I'm sure that feels great, when you're someone like me or somebody who's a professional. But for you, it's a little bit. Actually, that's an interesting question. I want to ask you a side note. We got a couple more questions here, but there's kind of a thing that I've experienced where a lot of CPAs are very conservative and very skittish to like, oh, you don't want to get audited or you don't want to do this, whatever. And versus a tax strategist is more like, no, we want to try to get you to zero. We want to try to get these other things. Like it's a different type of approach. Like most CPAs I find for that reason, they don't want to be kind of on the radar. So they'll do things where like, they're okay with you paying more in taxes because they don't want to raise a flag. Have you encountered that a bit? Or have you encountered kind of like somebody saying, hey, I worked with this person for years and man, I just paid all this more money than I needed to because they didn't know or they weren't comfortable with this? Or, I mean, I don't know, maybe you can talk to that a little bit.
Yeah, I mean, it's our industry is an interesting industry. By nature, CPAs or accountants or people that are preparing tax returns are usually very shy. They're not extroverts. They would prefer to be in a room preparing tax returns and not talking to you. So what ends up happening is you've got this downward force on cost because Joe, who is unregulated, because our industry is unregulated, that decided he wanted to start preparing tax returns and took a 2-week course at H&R Block, can charge $50 an hour because he doesn't have the education requirements. He doesn't really care about him making $12 an hour preparing a tax return. He just wants to get that business in the door. And so you've got this downward force, which then creates an issue for the CPAs, the individuals that actually have to get continuing education, the individuals that have to have the resources to be able to get educated, because that barrier to entry is the cost of that education. And so when you look at it, and I always say it, we have a research platform. We spend about $80,000 a year on our research platform. So we have that. That's because we've got 50 people that can shoulder that cost. But Joe, who's a sole practitioner, it might not cost him $80,000, but it's probably going to cost him about $10,000. And if Joe is only making $150,000 a year, $10,000 is a huge barrier to entry. And so he just doesn't have that education or that ability to educate himself on the intricacies of the tax law. So he's saying, I'm just going to be conservative. But really what he's saying is, I'm not going to go out and get the education that I need to be able to represent you in front of an audit.
Right. That makes sense.
So our industry is very weird in that. And it really comes down to the unregulation or deregulation of our industry. There had been some, this is my soapbox. There had been some things that had passed Congress. There was a law that actually passed that was going to require all tax preparers to have continuing education on an annual basis. And it got shot down in, I believe, the Supreme Court, maybe a district court, by the H&R Blocks, Hewitt Jacksons, and deemed to be unconstitutional to require people to have education to make money. There is now another law that is trying to make its way through that would bring that back. But until our industry is regulated, there's always going to be that drive down force that is going to create this gap where people just don't have the ability to educate themselves. And so as a defense mechanism, they're just going to be super conservative.
Yeah, absolutely.
So,
A couple more questions coming in here. So, do you have any clients using the strategy of selling a business or highly appreciated assets to an irrevocable trust or on an installment sale? The trust sells to a buyer and the proceeds to a trust bank account. The seller just receives the note and no cash. And there's a note saying this is not a monetized installment sale. So just like basically, are they selling and getting a note and then getting paid later, or selling it to a trust?
So there are estate planning strategies, and I know he threw out the monetized installment sale. That's kind of a no-no. But ultimately, there are strategies around that, and we do have clients that they'll sell an asset to an irrevocable trust in exchange for a note, and so they get essentially a note in consideration that they will get paid from the trust. And it's more of an estate planning tool. It's not a tax saving tool, because inside that trust, what you have to understand with the trust is probably the most restrictive taxed entity. Any income that is retained inside that trust is taxed at 37% above $12,000 of income. So instead of being an individual that you, as a married couple, might be able to get up to $600,000 before you pay 37% tax, in a trust, once you get up to 12, you're paying 37% tax. So in a lot of that cases, it's more of an estate planning tool to get that money out of your estate.
I gotcha. So it's more estate planning. This question kind of goes with that too. What are your thoughts on charitable gift financing?
If it works, it works. I mean, everyone's individualized. As long as you do it and you do it right, I mean, there shouldn't be any issues with it.
There was a guy that I know, as a friend of mine I know, he has a foundation. They give away, I think, half of their profits from their business to their charitable foundation. But yet they have a board on this foundation, but they're able to use the charitable foundation to like provide down payments on real estate and do some unique things that I thought was really interesting. Have you seen some creative uses for charitable stuff as well to kind of come in and provide strategy, or is that kind of discouraged? Or
so you run into self-dealing. rules within the code, and basically the self-dealing rules is it once you give the money to the charity, you
Gotta
can no
be
longer receive benefit from that money. So
right.
if you can make it arm's length and
Yeah.
you can figure out how to make it arm's length, then great. But if you run afoul of the self-dealing rules, the penalties are egregious. I
Oh
mean,
wow.
you're not talking a slap on the wrist. They could potentially, I think the penalties go all the way up to like 80%.
Oh my gosh.
Yes.
80% of profits or 80% of what's in there?
80% of the tax. So
Okay.
basically you have to pay the tax plus
Oh
penalties.
wow.
Yeah. Yeah.
Yeah,
Yeah.
that's
Yeah.
brutal.
So because again, all of these tax laws are also a result of bad actors. And so these are people that have tried to do something, and the code has come back in and said, okay, if you do this, we're going to go ahead and penalize you. So, I mean, excess in C corporations, a lot of people would do C corporations flat rate 21%. So I'm going to earn all this money in a C corporation and only pay tax at 21% and never distribute it out. IRS has come in and said, okay, well, now you got excess earning taxes, and we'll tax you an additional 20% if you keep too much money liquid inside a C corporation. So it's just things to be aware of.
Yeah, yeah, absolutely. There's a lot to be aware of in that as well. Some questions coming in about the real estate professional status, which I think is a great conversation. What kind of documentation generally do you think is required to support that?
As much as you possibly humanly can have.
Okay.
So I would say anything and everything. If you, I tell clients, whatever record keeping you can use from a time standpoint that is easy for you to use it, because it has to be contemporaneous. So it can't be something you go back and recreate. It has to be something that you can provide to them on the spot. I've had clients that set up Excel spreadsheets, and each worksheet is a month of the year, and then each line is essentially a day of the year, and they go and say, this is what I did this day, da, da, da. If you use an app that does timesheets, if you've got a time tracking software, if you use a day timer, whatever it is, it has to be as detailed as humanly possible. In addition to that, keep track of mileage logs, keep records of where you went. If you went and traveled to do due diligence on a multifamily property, keep the card of the realtor, keep the work that you did. I tell people, if you're trying to do this, get a separate email account, X, Y, and Z real estate. And that is where you track every single, you use it for email, you use it for real estate emails with brokers, with lenders. I know it's overkill, but real estate professional designation is the number one most contested thing by the IRS,
Mm.
and they will 100% disallow it.
And
So
that, and how often do you see that's a question or two? How often do you see that like people are getting audited based on that? I mean, is it common? Is it uncommon?
I
What do you
mean,
see?
yeah, it depends. So, the whole, when there was this whole idea of funding the IRS, and, this $82 billion over the next 10 years to fund IRS to put auditors in place, the current likelihood of an individual getting audited is like 0.0001%.
Okay.
Because I mean, there was 152 million returns that were filed, and I think of that 152 million, like 99,000 got audited. So your likelihood of being audited is very little, but it doesn't mean that you're not going to get audited. What they're looking at and why they're using AI and why they're using electronic filing is they're putting you against your peers.
Yeah.
And they're saying Joe lives in LA, Bronson lives in LA. They both do the same thing. They're what they say that they do for a living is X. Bronson makes $1 million. Joe makes $1 million, but Bronson only pays $50,000 in tax, and Joe pays $300,000 in tax. We're going to look at Bronson and
Yeah.
see why that is. So they're doing that on a grander scale, and they're looking at outliers. And so a lot of times you might get what's called a correspondence audit that says, hey, we noticed that your mortgage interest deduction is greater than what we would expect someone with your income to be. Prove that that is actually your mortgage interest.
Yeah. Right.
So,
And yeah, there was an inquiry I got this last year into some deal, and they're like, "Hey, we saw this. We needed more
mhm,
information." Or where it was from the state of California, which of course we talked about this. California looks at everything, right? The federal
correct.
government's not as, but California is super picky. I'm just going to stick your information in the chat real quick. So if somebody wants to reach out, I believe I got it right. Contact us at provisionwealth.com. Is that the best place to reach out to? Did I get that right?
Yeah, or you can just go to our website. If you go to provisionwealth.com, and there's a contact us up the top.
Okay, awesome. We're going to go a few more minutes. I just wanted to leave that for folks that are interested in connecting, because I think that really, I think when this comes down to making wealth and really trying to, all of us here, we're investing, not only investing money out there, we're investing in ourselves, we're investing in our own education. And well, a big part of that's your team, the team that you have, the people that are helping you. So if you are a passive investor, if you're an active investor, having someone like Tim or a group that you can go to and say, "Hey, I've got a question and I need to know what to do about this." It's really a big deal, and it's great to be proactive. And so, wanted to just leave that for you guys as well. So this is from Todd. This is a follow up here, talking about, I guess, that question about trusts. If the trust invests in syndications, I believe this was about the revocable trust. The trust invests in syndications using cost segregation. There's large depreciation deductions, plus the trust has the expense of interest payments on the promissory note. Therefore, the trust may have little or no taxable income. So I think the question is, if you have a trust and it's using depreciation, I mean, it could potentially be not taxable in the trust depending on the situation, right? That's a potential.
Correct.
Yeah.
It's yeah, everyone's as individualized as a snowflake, so it
Right.
just depends.
Yeah, that's right. Okay, cool. And then there's one coming in here from Tunrad about being a single parent with a business, just considering a tax strategist. If there's somebody who's just trying to be like long-term planning, is typically only high net worth people? Is my net worth typically more than 1 million, or is there a reason why somebody would say, maybe I'm not there yet, but I want to kind of plan this out and I'll hire a tax strategist? Or would it be maybe, hey, I'm not high net worth now, but I can, I'm getting an inheritance, or I'm winning the lottery, or it's other. I mean, what are some scenarios that somebody who's maybe not, who's kind of more in the planning stage of that would do that?
I mean, again, it's a function of being entrepreneurial. So if you're starting out and you're saying, hey, you know what? I'm trying to transition, trying to get out of being a W-2 employee. I want to do X. Well, you might not be a high net worth individual. You might not be an individual that has a high tax burden, but you have the need for strategy. So that would be a case where I would see that. But if you're a W-2 individual that never intends on doing that, is looking to invest in, LP and LP shares in, in syndications, then we might not ever be able to provide you the benefit that you need. So I think it's worthwhile to have a conversation. What we've found is, and why we kind of use those criteria is, number one, entrepreneur, because tax code's designed for you. Number two, high net worth, because again, the return, we don't ever want to be, as a team member, we don't want to be an undue expense. We don't want you to be like, man, I paid, $2,500 for my tax return. Joe down the street could do it for 300. There might be a reason, and I've done it on a lot of occasions where I said, you know what, we're going to be more of an expense than a return on investment to you. It would be better for you to have Joe do that return because he can do it. You don't have anything that's super complex. So it might be a function of complexity too. You might be in a situation where you're not a high net worth individual, but maybe you've got a ton of complexity in what you're doing.
Yeah, absolutely. And I think that's kind of generally, in business, you want to be providing, more value than what something costs. And if something's ever a place where it's like, hey, am I going to pay $10,000 for this, thing that is not going to, I'm not going to see that kind of value. And the nice thing about what taxes are and what you guys do, you can a lot of times quantify what that is and help. So I think that's great. So I don't see any more questions here. If anybody else has any other questions, feel free to drop them in. I really recommend that you reach out to Tim and his group if you are interested. I know there's some people in here that may have used him. Maybe you could put a little endorsement in there of him as well. But again, it's, we're not here pitching anything, and I'm just kind of, we want to provide these sessions, and we do this every month. We actually have another event coming up next week. It's actually next Wednesday. It's about physicians that are real estate investors. And so from the high net worth slash, physician, a lot of people like listening to physicians because they're obviously very smart. They study to be a physician, but also talking through some of these things as well as how they become a real estate professional or really been able to scale up. Some of these have raised, hundreds of millions of dollars. I think they've raised cumulatively over $1 billion from investors. From the three of them have done that. So, maybe somebody can stick that in the chat. I don't know if we have that, or maybe one of my team members can stick that in chat, but it'll be this time next week, I believe, the 16th, at 4 p.m. Pacific. So if the material says it's at 3:45, it's actually at 4 p.m. We'll get that corrected for next time. So thank you guys for being patient. Again, this will be available on a replay, so you guys can go ahead and check that out. But again, really appreciate each of you being here. Tim, any last comments you want to share before we wrap up here?
No, I mean, I guess my one comment to everyone is you drive your own shit. So you need to be the one that is out there looking for the team members that are going to help get you to where you want to go. So make sure that you're asking the questions, make sure that you're working with someone that actually cares about where you're headed and not just about getting you off their desk and, and looking to talk to you next year.
Yeah, absolutely. That's great. Awesome. Well, Tim, I really appreciate you being here today. Hopefully we'll do this again as a periodic thing. I think a lot of people have interest in obviously paying less in taxes. I think it's really great to be able to do that. And I guess one last question here. Somebody's asking about the time limit for an audit. Is it 3 years or 7 years? What's the audit limit, I guess? Or is
It
there
depends. Statute. I mean, it depends on what they find. The statute is typically 3 years, unless they find things that are materially misstated or stuff that would essentially keep the statute open. So
yeah,
typically
okay.
it's 3 years.
Yeah, I love it. I love the depends though. Like it always depends on, how it goes. So,
Yeah.
awesome guys. Well, if there's anything I can answer for you, obviously I'm not a tax professional. Tim is. We just kind of answer these questions generally, and he's answering generally too. So no specific advice given here, but this will be sent out as a replay. Feel free to share this. Do appreciate everybody making it today. Hope everybody has a wonderful evening, and we'll look forward to connecting hopefully next week at the Physician Investing, Real Estate Investing event. It's going to be awesome. So hopefully you'll be there, and we'll look forward to connecting with Tim, connecting with you again soon, Tim. So I don't think I've had you on my show yet. Have we had you on the Mailbox Money show? I don't think we had you on the show, so we got to get that scheduled. So I'll work with my team to get you scheduled for that. But thanks again for being here, brother, and hope you have a great night. Thanks everyone for joining today.
Yep. Thanks, guys.
Thanks, guys.